And warm welcome to everyone listening. Few things to cover today, but before we do that, just a little bit of a recap of what SKAGEN Kon Tiki is, in case we have any new listeners. So SKAGEN Kon Tiki is our global emerging markets fund. We have a global mandate, but obviously with a strong focus on emerging markets. As at the end of 2022, approximately 2/3 of the fund is invested in Asia, with the remainder spread evenly across South America, Africa, and Europe. Now, the team managing the fund, including myself, is also Katrine Geter, who has been with the fund since 2009, and Espen Klette, who joined us as an analyst in 2019 and joined us as a portfolio manager in the summer of last year. I think what's important to note here is that we've now been working together for a period of 4 years, and what we've seen is that the consistency of execution is starting to deliver improved results. In terms of what's characterizing the fund, there are 3 key highlights that we want you to take away. Number 1, it's a highly actively managed fund. We have a consistent active share above 80, as high as 90%. So this is independent of benchmark weights and clearly shows that we take a bottom-up and company-specific approach to idea generation. We also use the full flexibility of the mandate. To the right, you can see that the fund has a good balance in terms of market cap, but over-indexes a little bit to small and mid-cap names, which tend to be situations where we find less analyst coverage and perhaps bigger chances of mispricings. The fund has been going for 20 years, has always followed the value-based investment philosophy. And as you can see in the center of the chart, as we enter 2023, the portfolio has very, very attractive value characteristics, both in an absolute terms on 6 times earnings and 20% discount to book value, but at a near 50% discount to the broader MSCI EM index. If we look at the track record of the firm, as we will return to, 2022 was a difficult year with negative absolute performance, but we were managed to eke out a small outperformance relative to the benchmark of circa 2%. And we've actually had one of our strongest starts to the year since inception. And as you can see, the net asset value, net of fees, was up 8% in euro terms in the month of January, which was also almost 2 percentage points ahead of benchmark. So as you can see, as the team has now worked consistently together for a number of years, we are starting to rebuild our medium-term track record and are now also ahead on a 3-year rolling basis, as well as since inception. So in terms of what I wanted to cover today, there are 3 areas. 1, a walkthrough of 2022, summary of the movements there. How is the portfolio positioned today? And also, as Katrina and I, alongside our head of ESG, Sondre Myghe, spent a week in Brazil during the month of January, we also want to show you some examples of how we work as active owners and engaged owners with our portfolio companies. So we start off with 2022. It was obviously a pretty challenging year for most asset classes, particularly financial assets. And in terms of the US dollar returns, it was only really oil and the dollar itself that yielded positive returns for the year. And as you went further up the risk spectrum, you can see that equities performed poorly and emerging markets were weaker than developed markets.
Fredrik, I'm really sorry. We have some sound issues with your headset, I think. Could you move a bit closer?
Okay, so I'm hoping you can hear me better now as we go through the country returns. As I mentioned, emerging markets were a little bit weaker than developed markets during the course of 2022. That was largely driven by the bigger index components of emerging markets. You can see on the right-hand side of the chart that markets like China, Taiwan, and South Korea were all towards the weaker end of the spectrum, while smaller countries such as Turkey and Brazil did markedly better. For Kon Tiki itself, part of our performance during the year did come from our significant overweight in Brazil. We felt that the market entering 2022 was attractively valued and had built exposure accordingly. And as I will detail later on, we also had relatively good tailwind from our stock picking within what was a challenging Chinese market. Given the drivers I've talked about, both from an asset class and a country perspective, it's probably no surprise that our most positive contributors in 2022 came from the energy and materials space, while our negative contributors came from the write down of our Russian holdings, as well as our largest South Korean holdings, Samsung and LG Electronics. If we go through the positive contributors, the most important one was Chinese E&P company CNOOC, which delivered strong absolute returns during the course of the year, both driven by attractive energy prices, but also from a more clarity around their shareholder return policy, including a special anniversary dividend in that company. We've also long talked about our exposure to the energy transition and the metals needed to deliver that, and it was pleasing to see that both Turquoise Hill and Ivanhoe Mines, which were our largest copper exposures, delivered strong returns during the year. Turquoise Hill was helped by the fact that its controlling shareholder Rio Tinto launched a tender offer for the shares, so we have subsequently exited that position. Finally, we also had an attractive return from Asai, which is a Brazilian cash and carry operator, which continues to take market share and deliver attractive like-for-like sales growth. Just want to spend a little bit of time just on our Russian exposure, because it's something that we have had questions on during the course of the year. Here I'm using Norwegian kroner, so excuse me those who are looking at us through a euro lens, but this is our sort of reporting currency or functional currency. And actually what you can see during the course of the year, the entirety of our negative absolute return in 2022 was the markdown of our Russian holdings, which accounted for roughly 9.5% of the portfolio at the start of the year. As you can see in the blue, that is a significantly larger drawdown or portfolio impact than it was on the benchmark, which was just under 3.5 percentage point impact. What it does mean, however, is that our non-Russian holdings on a relative basis did very, very well, delivering a slight positive return, whereas the residual benchmark was down 7%. So how did we deliver that relative performance in our non-Russia portfolio? Well, to a large extent, it was driven by China. As you can see on the right-hand side, on the country attribution, by far our single biggest relative contribution came from our security selection within the Chinese market. If we delve into the details on that, again, forgive the Norwegian currency here, but I think the point stands. In the green, you see the index movements. In Norwegian kroner, the index was down 10.7% during the course of the year. And obviously MSCI China, the China part of the index, was slightly weaker, down 12.8%. However, when you look at the blue bars, which is our performance within those two components, you can see that the overall portfolio outperformed by 2 percentage points, including all of their exposures. Whereas if you isolate only the Chinese part of our portfolio, it actually delivered a strong positive return for the year and a more than 25 percentage point outperformance versus the Chinese part of our benchmark. And again, coming back to this, the stocks that delivered that performance, one of them obviously was CNOOC, which we have talked about during the course of the year. But I think it's also important to note that we had strong positive contributors from other parts of the portfolio as well, notably from China Mobile and China Life as well. And I think it's worth just highlighting one of the reasons why we got such tailwinds in China. Both CNOOC and China Mobile were put on the restricted list, which meant that US investors were forced sellers of these companies in 2021, and we were able to pick up heavily discounted shares from a forced seller, and that has clearly had a unwinding of that discount during the course of 2022, as well as the company have both continued to deliver both operationally and from a shareholder return perspective. The other thing to highlight within our China part of our portfolio is, even though we initiated a position in Alibaba as early as 2021, it wasn't a large position in the portfolio until the late autumn of 2022, where after the turmoil that we saw after the General Party Congress at the end of October, when Chinese equities sold off significantly, we were able to add to our Alibaba position quite significantly. And from a relative perspective, that meant that we recouped a lot of the absolute losses that we'd suffered earlier in the year. So in summary, the portfolio activities during the course of the year have been price-driven. We have added to positions that have temporarily worked against us. And as we've seen both in the fourth quarter of 2022 and in the start of 2023, those kind of contrarian movements have started to pay off quite handsomely. If we go into the portfolio today, I think we sometimes make the mistake of stressing how discounted the valuation of the portfolio, and we forget to talk about the quality that's in it. We know that most of our unit holders are interested in emerging markets because of secular tailwinds or secular themes that they want exposure to. And I just want to highlight here that throughout the breadth of the portfolio, we tick off a number of those themes. I realize that this chart is in Norwegian, so I'll talk you through it. On the left-hand side, you have health and well-being, you have daily necessities, electronics and lifestyle, technology leaders, online and internet, energy and materials, and the energy transition. And as you can see across the portfolio, we have exposure to some of the world's leading technology companies, such as Samsung, such as TSMC, that we added to the portfolio last year, as well as clear beneficiaries of the electrification of transport and our energy system, as well as good inflation protection from both energy and materials companies. If we go in the top 12 of the portfolio, there haven't been any major changes here other than just managing position sizes as share prices move. Our single largest position remains Ping An, the Chinese insurance company, which we believe, despite a significant rally in the latter part of 2022, is fundamentally undervalued for the type of quality company that it is. And as we see the China reopening now developing, we have no doubt that the agency force that has been unable to meet with potential clients will be able to sell their life insurance products in a greater way going forward. Also, I think it's worth highlighting that some of the names here may not look like they have very discounted near-term valuations. You can see the range of price earnings multiples in the portfolio is from 3 times to almost 40 times earnings. And it's just, again, to stress that our approach is not to run mechanical screens on low valuation multiples. We have our independent analysis of every single company, our own forecast, and also our proprietary valuation framework based around scenario analysis. And that's what informs our expected return or upside to target price. And as you can see on the right-hand side, even though we've had a very, very strong start to the year, the portfolio retains an upside in excess of 50% on a 2-year view based on our analysis. In terms of the changes in the portfolio, in order to keep it fresh and also maintain the upside, we made a number of changes during the course of 2022. 8 stocks came in and 8 stocks left the portfolio, so the number of holdings remained stable. I think the ones that we haven't discussed on previous occasions are to some extent TSMC, which many of you may know, but it is the world's most important and most profitable foundry operation, absolutely critical infrastructure for the data age, and the shares sold off significantly during the course of 2022, partly on cyclical downturn concerns, but those were exacerbated by the geopolitical tension between the US and China, which gave us an opportunity to build a position at a very, very attractive price relative to the fundamental upside that we see, but also relative to the stock's own trading history. Our latest addition to the portfolio during the course of the year was Banco do Brasil, which is a very interesting state-owned bank in Brazil. Has a relatively cautious lending book, good asset quality, and a very, very attractive, in our view, shareholder return policy. It looks like we will be securing a near double-digit dividend yield from this one, and it gives us sort of some ballast in the portfolio and sort of income generation that we think, given the uncertainty, is very attractive. And as we had mentioned on previous occasions, we had been looking for a bank with similar characteristics to what we had in the Russian bank Sberbank, which is currently priced at 0 in our NAV. In terms of the changes on what went out of the portfolio, the most recent ones were Turquoise Hill, which I mentioned have now been acquired by Rio Tinto. So we sold that out at a significant premium to the price that we had paid, and also where it had been trading prior to the approach. While Mahindra is an Indian company that we had owned for a number of years on and off, and as the shares reached our target price, we sold out of the position in order to fund our other new positions. In terms of the portfolio snapshot, you can see that by sector, there our single largest kind of overweight positions are within energy and materials, although both of those have come down slightly as we have been realizing some of our gains in those areas. It looks like consumer discretionary is a very large part of the portfolio, but part of that is just a fact that Tencent, Prosus, and Naspers, which is kind of an ownership structure there, are classified as different sectors, and actually our economic exposure is relatively similar to the benchmark. So in terms of the big deviations, it's still within energy and still within materials, but less so than it has been about 6 months ago. By country, we've clearly had a very strong rebound, not just in the overall emerging markets, but particularly so in China and to some extent in Korea. That does mean that our weightings are floating up in those countries, and we have made some minor adjustments there in order to maintain the portfolio balance. And as we are price-driven investors, when things are falling, you should also expect us to act in a similar manner when share prices go up, and therefore you shouldn't be surprised to see if some deviations start occurring there. Other countries that are worth highlighting is that we've had some questions historically about our exposure to Vietnam, whether or not that's a market we are looking at. It is a market that's difficult to access directly as a foreign investor due to foreign ownership limits, but we do hold positions in 2 closed-end fund vehicles listed on the London Stock Exchange, which does give us a 3% exposure to a sub-portfolio of Vietnamese assets, because we do share the view that this is a very exciting country for long-term investors such as ourselves. The other thing to highlight is that India, you can see that the fund currently has 3% exposure to India. That's through UPL, the crop protection company. And it is an exposure that came down during the course of 2022 as we sold out of Mahindra. And we have also had previous holdings in India that we have sold on valuation concerns. Now, unfortunately, we can't claim to have had the foresight that the Indian market would go into a bit of a drawdown on the back of what's going on with the Adani Group and the Hindenburg short seller report. But as we approach every kind of situation, we do think that valuation is a good pinpointer of where optimism is at any point in time. And if you have an embedded high optimism in the share price, the downside risk is more material. So for us, it was simply that every time we looked for opportunities within the Indian market, we weren't able to justify some of the valuations that we were seeing, and therefore on a bottom-up basis we simply don't have as much exposure to the Indian market as perhaps some of our peers do, and certainly on a relative basis that means that we have escaped some of the carnage that has happened in that market year to date. But I can assure you that with the type of price action that we have seen, you should expect us to start looking at it more attentively again. Now, this is a chart we've been showing on a regular basis over the last year or two, and it is sort of more of how we think about the portfolio from an economic cycle risk perspective. And again, you know, we do run the portfolio on a bottom-up basis, but keep an eye on the top-down risk management. But I think it is worth stressing that given the uncertainty around the economic cycle, both relative to inflation expectations, but also with respect to economic growth outlook, we are not placing a big bet one way or the other. We have built a portfolio of companies across sectors that do well in different economic scenarios, be they high growth, high inflation, or low growth and low inflation. And where the logos of our portfolio companies are mapped on this chart is based on the historical performance of the sector that they are in relative to the MSCI EM index, i.e., the type of environment in which these companies outperform is the box in which they are. And as you can see at the moment, because there is a high degree of uncertainty, we have a big exposure both to a stagflation type scenario in the bottom right-hand corner, but also because valuations have come down quite significantly in the more cyclically sensitive areas such as information technology and internet names. We have also seen an increase in our weighting to those themes. Before I round off with our active ownership and practice, I just want to again, you know, show the characteristics of the portfolio and put them into context. So this is third-party data from Copley, which is a benchmarking company. This is based on their database of almost 280 global emerging markets funds. It shows where Kon Tiki sits relative to peers, both on a valuation, but also on a return on equity or a type quality metric. As you can see, the portfolio sits all the way out to the left. So one of the cheapest portfolios, both on a PE, but also on a price to book basis, but that is without sacrificing anything in terms of quality and the returns that those companies are generating. So in our view, one of the ways to build a robust portfolio that can perform under various scenarios is to have similar or higher quality, but at a discount. That should give us protection on the downside, and that's the result of our bottom-up security selection. So before we round off, I just wanted to take a few minutes to talk about our latest trip to Brazil. As you can see from the photos, we had a pretty busy week in the outskirts of Sao Paulo, but also in the Mato Grosso state, which is bordering on the Amazon. It was Katrina and myself, as well as Sondre Mige, our head of ESG. And as you can see, this was not a trip where we spent a lot of time in the offices of investment banks or the companies themselves. We went out to see production facilities, to meet operational management, to meet supply chain people, and to actually see the areas where our companies operate, how they behave, and who are the people who are running these businesses. And I think it's worth stressing that as an active and long-term investor in these companies, we had very, very unique access. This was not an organized trip with anyone else. It was a SKAGEN visit to these companies. And as you can see, we visited 8 companies during the course of the week, including the conservation areas and the production facilities of Suzano, the paper and pulp producer. We had a chance to look at their R&D center, where they are actively working on the plastic substitution strategy of the company. Where can we use wood-based fiber instead of oil products, which we think is a very, very exciting potential. And as you can see on the big site, that's one of Raizen's earliest ethanol production sites, which is based on sugarcane. And Raizen is actually one of the more exciting companies in our portfolio at the moment. We were able to increase our stake after our visit. And I think it's worth just giving some examples of why we think this is an exciting case. Brazil is a country which has all the sort of natural resources in order to be part of the circular economy. You have renewable energy, you have significant biomass that you can work with. And in the case of Raizen, they have vertically integrated sugarcane, which has always been a key input for them to produce sugar as well as ethanol. Ethanol is a key part of the fuel mix in Brazil. So every petrol station will sell you up to 27% blended petrol with ethanol. And what we have with Raizen is a second generation ethanol production plant, which actually uses 50% more of the sugarcane plant. So you get much higher yield from the same amount of biomass. That also means that some of the byproducts can be used on site for your electricity production through biogas cycle. So not only do you get a much higher yield from your harvested areas, but you also get a much better integration in terms of full cycle energy needs. And I think what's interesting with this company is that they are now rolling out these bioenergy parks. We had a chance to visit one of the construction sites, and very much in the same way that we were following the development of Kamoa-Kakula copper project of Ivanhoe Mines in the DRC, both through drone footage, but also through on-the-ground site visits. We can now compare what we see from the quarterly results presentations. We have an example here from Raizen. Bottom right-hand side, you can see the progress in terms of construction. And if we add in our own experience from a couple of weeks ago, you can see that the project is developing, albeit admittedly not entirely to schedule, but according to sort of the broad outline of the plan. So I think to sum up, hopefully there is not a huge amount of change in our messaging. We are an actively managed global emerging markets fund. We have a clear value-based investment philosophy, and I think we can show that our focus on long-term and sustainable returns is something that we follow up with boots on the ground. We can see it in the way that the companies deliver, and our interaction with the companies is the best way for us to make sure that remains on track. The portfolio with under 50 names is a concentrated portfolio, but it is diversified not only across geographies and sectors, which is how most people look at it, but as we show through our macro cycle clock, we are also trying to not take a single big bet on any one scenario for the future, because we simply don't know what the future will hold. And if 2022 showed us anything, is that planning for what is ahead is quite important, given how volatile the markets were. And it's easy to pay lip service and say that sustainability is an integrated part of the way that you work, but hopefully by showing that the investment team and our ESG team works together, travels together, meets companies together. We are not meeting these companies with one agenda each. It's one agenda on behalf of our unit holders and the way that we say that we will manage the portfolio. And finally, it's been a strong start to the year, partly a rebound from what was a weak 2022 across most financial assets. But as we try and show in the portfolio by continuously tweaking the portfolio to where we see the highest upside, and the fact that emerging markets continue to trade at a modest discount relative to their own history and also towards developed market, we continue to believe that the fund can be a pretty good building block in a diversified and long-term oriented portfolio. So with that, I thank you very much for your attention and hand back to Ole Christian.
Thank you very much indeed, Fredrik. Now we have a few questions for you, and they both sort of touch upon the Russian war against Ukraine. So the first one is, how do you assess the impact of the Ukraine war on China and India when it comes to reshoring, for instance?
That's a big question, but I think, look, I think the first thing is what it drove in terms of investor nervousness. So 2022 showed that, you know, macro or geopolitical events can overshadow what happens at individual company levels for extended periods of time, but not forever. So I think the way that we are trying to assess this is that we used elevated risk premiums when they were available to buy deeply discounted shares of companies that we are comfortable with, that we think are well positioned for the long term. And then obviously a large part of our research at the moment is what does it mean longer term for the way that we will position supply chains? Will it change winners and losers? And there, the only thing that I can say so far is that, you know, we have 25% of the fund in Korea. Korea competes with Taiwan on a number of areas in terms of technology. Korea is welcome in the US. Korean companies are welcome in the US supply chains in a way that Chinese are not. So obviously we think that they have a role to play if we want to diversify supply chains, and that's the most sort of tangible example that I can give at the moment.
Right. Now, the last question is about your Russian holdings. They are currently valued at zero. What are the outlooks of getting rid of them eventually?
So we had 5 holdings, Russian holdings, at the start of last year. 4 of them are currently valued at zero in our NAV. Those are locally traded shares in Moscow, which due to several sanction regimes means that we are neither able to sell them nor to repatriate a hard currency. So those we will sell when we are able to do so in a good way in the interest of unit holders, and that's something that's been communicated by both SKAGEN and by Storebrand. The one holding that is not valued at zero is X5, where the global depository receipts still trades off market in London. And in the same way that we do for other thinly traded instruments, we use a fair value assessment of that, which is done by an independent team within the Storebrand group, so that we use the same price across all the funds on Storebrand's platform. But details of that holding is in our monthly reporting.